Great. Well, welcome to our Sydney Markets Happy Hour podcast. I thought it's good to give you a little description of what this is. This derived from a weekly chat with the CIO that I did every week from in my private wealth firm. It's designed as a way to crystallize thinking week to week on what we're seeing in markets. And I think really importantly, which is often not done, is translate that into what it means in a portfolio. Because we can all rant for hours about market conditions, but really, so what is always the question.
Yeah.
What does it mean for us? And this live event has come out of traveling around and finding that being around a small salon style group like this is really interesting to hear what the details are like on the ground in terms of, do the headlines reflect reality? Does Main Street meet Wall Street? And also if you hear about the nuances. For example, hearing about the nuance of the Australian economy, I'm not going to get from a headline. So I think if we can capture that here and then basically then process it, I think we will have a deeper understanding. So every week we talk about these five lenses. It's inflation, interest rates, geopolitics, equity markets, and other asset classes. Given we have somebody from the private equity sector here, we may ask about what you're seeing on the ground from private equity. And we have a few subtopics before I ever introduce Annette. Really, inflation is sparing few countries as we look around the world. It's certainly a dynamic that, despite the fact that Japan seems to be heading, of course, 2%, it's pretty much universal. We're going to speak about economic vibes, both here and in Australia. Not here, but both in the US and Europe and in Australia. We look at how equity markets continue to defy gravity again and see whether we can make sense of that. And then, as always, I mentioned portfolio implications. So here's Annette. She is an investment manager at Hesta, one of the primary superannuation funds here. And your specialist is market strategy and portfolio design. And I'm not sure if you want to say another word or two. You quick intro, but
So yeah, lots of financial market economists, so used to making decisions on the ground. So doing that to 30-year portfolio management and trying to bridge the two, because you still need to know what markets are doing, but we also need to position for the future. So it's a nice mix.
Yeah, great. So the way we'll do this is I will show a slide or two, and I'll pass it then to Annette to give your impressions of what we're seeing, what I'm seeing, and we'll kind of have a bit of back and forth on that. She will definitely take the lead on the Australian crystal ball as far as what's happening tomorrow in the budget and elsewhere in the economy, but we will go from there. So clearly, when it comes to inflation, we all know that it's a bit of a tough last mile to get inflation back in check. We've had the Strait of Hormuz blowout around the Iran war, oil prices under pressure. We know that the Fed has cited inflation as misbehaving. And the only country that is showing some restraint, it seems, in inflation is Japan, which is probably a function of their expectations. They've been mired in deflation for so long that they can't really get beyond that. And in a way, perhaps inflation expectations here and elsewhere, it's what keeping inflation so high as consumers bring forward expenditure and the expectation will be more expensive later. So the Australian chart I pulled for this is your target range of 2.3% and your existing currently about 4.3. So I suppose, Annette, over to you in terms of, is this a kind of a comfort level that you're at here, or would you see that it's presenting a challenge, and as reflected, as we'll discuss later, in the interest rate movements?
Yeah, there's no comfort here. Like we've gone from an era in the 2010s where you couldn't get inflation into the target, which is two to three. For a long time, it was just under 2, and whatever they did, so interest rates got lower and lower and lower, trying to get people to actually think and talk about inflation. And then we had the 2022 issue of as we know, the COVID. Everyone was locked up, and of course, once you let people out, they all started spending with gay abandon, and so off we go. And that's why you can see that pop there. In the inflation rate, which brought the RBA back to the table then. And then we thought we were in a sweet spot. Inflation's coming down, expectations were under control, and interest rates were cut last year. And we were like, happy days, this is great. But then we started to see the turnaround. So in fact, even before that first Iran strike on the 28th, we actually already had an inflation problem. So we're looking at headline all the time, because headline is what's going to give you that jump around in fuel. But if you trim that out, that's what the RBA actually targets. And even that is sitting above 3%. So if the target's here, we were here already before that strike. And so while we'll talk about interest rates later, inflation was already in an uncomfortable position, and the Reserve Bank had its own challenges with our economy growing at 2.5. Apparently we can only grow at 2. We can talk about why later. We can only grow at 2, but we're growing at 2.5 as at the end of last year. So we had a capacity problem, we had an inflation problem, and now we've got a fuel problem. So all of that on top. So that little pop you see there, on our forecast, it's probably going to be again back to 5 in the coming quarter or two. So sort of brace for that, because fuel, when you're a country this big, you need fuel to get from one end to the other. And so it's not just fuel that we're paying for, it's fuel that businesses are paying for, and they'll pass that on, and around we go.
Yeah, 5 is definitely well beyond, I think, a consumer comfort level,
Absolutely.
I'd say, on inflation. And this is maybe when I can put it out to the floor for a very quick vibe check in terms of the consumer experience. I hear a lot about house prices and on a lack of affordability. Put it to you, anyone want to volunteer an on-the-ground observation regarding cost of living or your experience of inflation? Is it as bad as we say and we predict?
Yes, I think it's the answer. I sort of noticed that, on two sides in our business, we have a lot of contracts and prices that go up by CPI. And, we budget for that, but our long-term models, you have a couple of years of whatever the curve is, and then you can't assume 2.5%. And so when you're getting up into that kind of 5 territory, it does have an impact on the business. And then personally, buy the same products at the shop for years, and you see the price that's gone up well above inflation. And so you can see it at a personal level, see it at a professional level.
And do Australian companies have the pricing power to push it through to consumers? Are the consumers taking the hit, or are the companies' margins taking the hit? Any observation on?
Well, I think we're well-known duopoly here in the grocery market. So the Coles and Woolies, and then the Aldis and the independents by a long way. So I still think you can probably, I'm not advertising any particular grocery option, but the idea that you buy Aldi for the basics and then the good stuff from the Coles and Woolies, there's been endless government reviews, as you've probably seen as well, as to is their price gouging. And because I also look at equities, I look at equity research, and they basically say there are wide margins there in the grocery business. So what's great for Coles and Woolworths is not great for consumers on the ground, no.
So let's take it from obviously the kind of the flip side of inflation is interest rates. So clearly we know that let's just give a little picture around the world. We have rates kind of stalling around in the US. They paused. So we thought they were coming down, and now with inflation misbehaving, the Fed seems to have stalled. We know that around the world, the government bonds are trading quite wide, reflecting a lack of confidence in the fiscal situation, as well as in particular cases in the UK, just the particular government and that perhaps its own stability there. But overall, we've seen now, I say, a reduction in the expectation of rate cuts. But Australia is bucking a trend and having 3 consecutive rate hikes. So talk us through that in terms of. That was a fairly gutsy move. I know that Hesta is a gutsy advocate, right? But
we're not a gutsy advocate for rate rises. I'll give you the tip. I wouldn't have gone the 3rd time, but that's my opinion. A lot of the thing about my old financial markets hat is whether they should or whether they shouldn't doesn't matter. It's what they do. And so they already hiked in February. They hiked in March. Then as you say, then the conflict started. I personally wouldn't have hiked for the 3rd time. And just for a bit of background on that, and I'm sure most of you know this, but just a reminder, because we have variable interest rates, it hits us straight away within maybe a 2-week lag. Whereas if the US can hike and cut all you like, you're sitting on your 30-year loan. So that transmission mechanism into the US is much diluted. Whereas with us, it hurts like straight away. So we've had the 3 hikes. As I said, we were growing above capacity. Unemployment rate here at 4.3. That was, speaking of studying economics, I studied economics in the Jurassic era. And we dreamed about having an unemployment rate of 5, let alone an unemployment rate around 4. So that's also low. So all of that is what got the RBA to the table. They're still worried about having an inflation problem turning into expectations, as you rightly point out. And so every other major central bank met at the end of last month. Nobody moved except ours, because they had that demonstrated problem before the conflict. Bank of England was priced for 2 more cuts. They've stopped. The Fed was priced for 2.5 cuts, and they've stopped. And well, BOE is a bit of a mess because that's a fiscal issue. But anyway, so when you see that chart of interest rates rising and rising, there's 2 elements of that. One of it is the cash rate, because all of them are priced for at least 2 rate hikes, if not 3. Even the ECB is priced for 2.5 cuts. The other element is inflation, because you want to be paid, because as you know, you lose your purchasing power over time. So you want to be paid to hold these bonds. And then number 3, who the heck has heard of fiscal austerity? What happened to getting the budget back in balance? No, the US is a disaster. Australia, they're trying, but we'll talk about budget later. And fiscal mess is well known in the UK. So all of that, so 3 elements is why your your fixed income element of your portfolio just isn't returning anything right now. Unless you buy and hold to maturity and you collect your 4 or 5%, like in an income ETF, for example, you can sit and collect that. But if you're looking for capital gains, you don't get it in this environment.
And the interesting thing is you're not getting much safety out of the fixed income either. I mean, you would have thought maybe during the war that buying fixed income was a nice safety trade. It has not been doing that, as you can see. It's been selling off.
And it's so bouncy. It's meant to be set and forget. You're meant to sleep at night when you have a fixed income portfolio, not ride those tides and feel nervous. That's not the role of fixed income.
And let's get back to that unemployment number, 4.3%. You mentioned the inflation and the relative economic growth at 2.5. You said the
2.5 is high for us. Yeah.
So is this an economy in danger of overheating because of that? And is this monetary policy, the rate rise, is going to act as a brake on that overheating because of the transmission effect?
Mm-hmm.
Or do you think the economy will continue to what is the consumer spending that they cannot address?
Well, I was literally looking at this for a separate project, because we're wondering are the risks of recession higher in Australia because we've had those 3 rate hikes, so there's risks of more of them. So the consumer is 55% of the economy. So you need that consumer to slow down. So as I sort of suggested before, so post-COVID, we're all locked in our rooms, then we all spent with gay abandon, then interest rates went from 0 to 4.35, so everybody stopped spending. And then we had the 3 rate cuts, so spending goes up. That's a cycle that's supposed to happen. So if it gets a little overheated, you hike and you come down and then you cut. And this we're in a bit of an era now where we're getting a bifurcated consumer, and this won't tell you anything. The older cohort, and I hate saying older because it's basically 55 plus. So I'm not old, but I am on paper. So that era is spending with gay abandon. They've got their retirement, they've got their long run assets performing, and they've got a degree of sitting on interest rates. Term deposits, I just looked it up, $1.7 trillion worth of term deposits. Tends to be the older cohort. So they're having a great time. So if you increase interest rates, they're just going to spend more. But of course, then there's the mortgage belt. And we know the mortgage belt, as we say, we're exposed to those variable interest rates. The more they go up, the more that's going to hurt. But the RBA can only deal at the national level. So if retail sales are sort of bobbing along, not knowing that these guys are hurting and these guys are going on multi-billion-dollar cruises, they can only deal with the national average. So the RBA does feel compelled to get the national average down, and that does mean hitting that mortgage belt. And just one more element of interest rates and what the RBA should and shouldn't do. A lot of the broker research has shown that if you increase fuel by 40%, you say, have you noticed? Of course you do. You drive past it nearly every day. That's worth 3 rate hikes as well. So we've had 3 actual interest rate hikes, as well as the equivalent of 3 interest rate hikes. And the thing about fuel is it impacts everyone from students through to the older cohorts. So that's an even more effective brake, I would have thought, on the economy. And so that's why we're starting to discuss, is there a risk that they overdo the slowdown because of the combination of fuel plus interest rates? That's the risk.
I was chuckling in the talk of the spending on cruises. That may be getting diverted if hantavirus concerns are likely to. But it's an interesting point about that the silver economy, I suppose, in terms of the older end. There's a couple in terms of the fog of jobs. I think this is important because we have a lot of mixed messaging around job situation. Besides the fact that Australia has a low unemployment rate now, in relative terms, I think that youth unemployment is still 10%, but so it's a little higher. I think that's according to the statistic.
Yeah, it's higher, but it used to be 20.
Okay.
And that's why sometimes context is important. Media don't have time to put context in, so you just get the clickbait. So I understand that. The era of the 2010s when inflation kept falling, one reason why it kept falling is because underemployment was double digit. Now, what is underemployment? That means you're working 6 days a week, but you'd really like to work more. And that's what keeps wages down because you're available. You don't need to entice people to enter the workforce because they wanted to work those hours. That underemployment rate is sitting at about 6. So there's no unemployment, there's no underemployment, and the youth is low, but again, a lot lower than it used to be. So it's tight from all angles. One thing that is particularly true with headlines like this is, again, there's no context. So you've probably heard AI is going to wipe everybody out. And so you get Silicon Valley, sacks 10,000 people. Now, if you want the US unemployment rate to go up by 1, so it's currently 4.3, for it to get to 5.3, you need to lose 1.7 million jobs. Not a couple of hundred or even a couple of 100,000. You need to lose nearly 2 million jobs in order to really move the dial on that unemployment rate. And another element that's not in these, but you probably could say all the jobs are in healthcare. Great for us, they're new members because the H in Hesta is health. So we do look after health, aged care, childcare workers. So there was a bit of pushback going, it's not a real job because it's a government job. And I'm sorry, but government education, government health, police, nurses are all very important government jobs. So it's a little misleading to say that the labour market is tight because of government jobs. They're government jobs that we really need.
But that's in Australia or in the US? So I think the US.
It's actually global.
Okay.
It's global.
Yeah. I think it's a very good point. I mean, about the nuance and right with these 10,000 at Facebook, whatever, that's not going to move the needle. But it is going to shock. I think it's going to send a chill through the labour force to the point that they will not flex their muscle around looking for pay rises. True. They may not unionize. I think these are important, just I suppose, erosions of the power of labour, which is again back to the earnings picture is also quite solid, I'd say, as far as that's concerned. You mentioned consumer sentiment and a K-shaped economy. This is a chart from the US, and it reflects the K-shaped economy as it is reflected in. I mean, we're seeing plenty of K-shapes, but this is around as it's reflected in the different sectors. Here, the consumer discretionary has performed better because that's the high end, perhaps the silver consumer in consumer discretionary. Staples index has performed poorly because we know that that there isn't, perhaps this is where the lower end consumer is struggling a little bit more. I don't have a chart with the. I
would just say one thing here, like consumer staples are seen as a defensive. You need to eat no matter where you are in the economic cycle. So it's defensive. And you can see that black line actually doesn't really, if you extend it, it barely moves. So it's a true defensive. It actually surged, as you can see, with the war, because we're sort of like, I need to get my food from a truck or a train or a plane. I better get in. So people piled into defensive stocks thinking this is what I need to do because there's a war. And when you're uncertain, you pile into safe. And defensives are safe. And then people thought, war. I don't care about the war. We could discuss that separately. But they're like, what war? Well, let's just move on. And so that pile into safe stocks didn't last very long.
Well, I think let's move this to the category of things that don't seem to bother the stock market. We talk about things that do, because geopolitics is not bothering the stock market. The fiscal position is not bothering the stock market. The consumer sentiment is not bothering the stock market. Is at an all-time low. Because of this K-shaped phenomenon that 10% of consumers reflect 50% of expenditure. So I think on that basis, why are these things, in your experience, not bothering the stock market?
They're not bothering the stock market because AI is still delivering. And this is where we sit here, trying to manage a portfolio. And the tech concentration issue has been an issue for like a couple of years. A couple of years ago, we were like, this AI thing, what is it? Next thing you know, we've gone from AI thing to running the entire S&P. There's lots of charts, concentration risk. earnings upgrades are only in the tech sector. Our performance is only in the tech sector. And so it feels like as long as we've got a tech sector, everyone else will eventually benefit. Not sure if I buy that. And when you look at, like, we just had a ripper earnings season out of the US, like 80% shot the lights out. Is it because people were so depressed that you shoot the lights out? Or is it just because people are not disappointing, therefore you're shooting the lights out? You need a psychology degree, I find, when it comes to expectations versus reality. But after all of these years, like Nvidia is still performing, TSMC is still performing. All those now household names are actually delivering on expectations. And we just sit there and go, until they don't. But at the meanwhile, it feels like betting against it is a great way to lose money. And so people aren't betting against that phenomenon.
And I suppose I should say we've such a wealth of experience here. If anyone has questions for Annette, please do come in with any before we move on to discuss the equity markets. Anything on sentiment or any thoughts as to why these factors are not affecting? It is a little bit almost like a hierarchy of risks. While the hierarchy, what we're focused on, we're something focused on the AI right now. We don't seem to be as focused on some of these other risks. They've receded because the good times are rolling. What I would say, just in terms of this, we've talked about the US and these margins are great and US exceptionalism. I think it is important to talk about US exceptionalism here when we're outside the US. Can you tell us about the dynamics of the Australian equity market in terms of, just like my vantage point of the UK is that it's increasingly getting less attention, fewer IPOs, it's shrinking, it's an old economy stock market. And as I've got a chart here showing the basically the America's war is Europe's problem. Because essentially this war in Iran is taking its toll on volatility in the European indices, and also European indices are taking a toll. The US index is still charged by AI and tech. So before we move into other aspects of the AI story, tell us about the Australian stock market and its profile and whether it's also suffering from this lack of attention.
Yeah, we're definitely underperforming recently. A quarter of our stock market is banks. Everyone knows the household names here. A quarter is in resources, and the rest is, to be honest, rats and mice. We've got consumer discretionary, consumer staples. Our tech sector is like 3%. So it's there's like literally three tech stocks, I think, that just shot the lights out because they're like, tech, I must buy tech. And that is great, worked out well for them. So we are the old economy. We still dig things out of the ground and we send them to China. Unfortunately, that's what our stock market represents. So at the moment, China's actually quietly over there having a really good time watching everyone else duke it out because they know they're the ones with the rare earths. Then, like, Xi and Trump are meeting later this week, and Xi's like, I'm sitting on the rare earths and you want them. So that they've got their leverage. When we come to Australia, so as long as China's doing okay, we'll be left alone, which is normally the case. So if China does well, we do well. What are we facing? 3 consecutive rate rises. So this is why Australia is just going a bit sideways at the moment. It's just because the RBA is determined to get the economy back below trend. And that's just weighing on our markets because that's going to weigh on the banking sector, which is a quarter of the index. So that's why we're sort of missing out. But I have to say, I've seen Australia go through the old economy. You know, the TMT, the last tech boom. I was working at Citibank then, and we were watching the Aussie dollar sink like a stone because they were like, oh, Aussie, who cares about Aussie? They just dig dirt out of the ground without adding any value, and we don't have any tech. So Aussie equities and Aussie dollar just collapsed. And then suddenly China and Japan start competing for our resources, and suddenly we're back on everyone's radar again. So if you're around long enough, these things will happen in cycles. So I think we're in the old economy cycle. But as a long-term investor, we're investing in what will be the new economy cycle, which is your copper, your nickels, your rare earths, because Australia's got all of that. We just need to develop it.
And I think an important difference between Australia, say, and the UK is the UK pension funds are not investing in the UK. They're actually pulling back, they're de-risking, the government would love them to do that. Here, your superannuation system is still such that there will still be a captive institutional market for Australian equities. Is that correct? So
that is correct.
Underpinned by that.
Yeah, so APRA, your Future Super test is basically they give you a benchmark portfolio. So you're about 25% Aussie equities and you're about 60% international equities, and then there's other rats and mice. Sorry, rats and mice being the private markets, which are getting better. So we can talk about that shortly. But at the moment, the private markets are not in this index. So of course you want to beat the index, because if you don't beat the index, you'll fall off and you'll lose your members. So you can't have that. So in a way, we're structured around a pretty tight portfolio, but the Australian super industry already owns 25% of bank bill paper and 25% of the Australian equity market. We've pretty much hit our limit on what we can hold domestically. So we're lucky to be in the top 10 with 100 billion. So the others are like 300, 450, like more dollars than it's insane. When you've got a 30-year compulsory system, this thing is compounded over time. We're too big for the Australian market. So yes, we hold Aussie because we're told to, or it's a big bet if you don't. And if you get it wrong, you're out. But looking elsewhere for growth and returns will be increasingly the driver of portfolios.
But at least there's a backstop of some Australian.
There's some compulsory element of holding. Yeah.
Well, when we get to just let's quickly talk about the US markets in terms of the AI under the AI driver, because I think this is the kind of $1 million question. This is about earnings. I think we already reflected that earnings are strong. It's getting small here. The profit margins remain very robust in America. That's another kind of distinguishing feature. These are the justifications for this ongoing US exceptionalism as we see it. There's a lot of momentum behind that. The chip makers are seeing a euphoric rise. Yep. This has also extended to Korea and Samsung, and today again, more, I think 9% in terms of the semiconductor index. Samsung is has gone up 5 times, I believe, since the beginning of the year.
Yeah, Korea hit limit up today, 5%.
Yeah, so there's clearly a frenzy at work here. You mentioned how well the blowout earnings were and the revenues for the top tech stocks. Clearly, everything's price to perfection. How do you see that segment right now? And then we can talk about the adjacent segments before we even go on to talk about the budget coming. The US tech clearly right now is firing on all cylinders, and it's 75% of US GDP. Can that be sustained, or do you think that there's a need to diversify and that there's perhaps too much concentration?
Yeah, it's a tough one, because what they're building in Australia as well is data centers, very unattractive blocks that hoover up a lot of energy. But the US is building them, we're building them, we're building the data centers for the future on the idea that we will need AI in our lives forever. The issue is, are you spending too much money so that there is not necessarily the return on investment? That's there's 2 hard parts. One is, what's the return on all this investment? If you build all these data centers, will you get your money back over time? And I think the other issue of, what we're going to do down the track is, tech is supposed to be great for productivity. It's meant to be deflationary, like it's meant to have a macroeconomic euphoria as well. And that's really hard you can sort of guess it and put it in your models and make an assumption that productivity is coming. It's also hard to see. So what we can see are chip demand, chip imports. Aussie had a trade balance released last week, imports associated with data centers going through the roof. So they're happening. So you need materials, you need labor, you need resources to build these things, all of which is inflationary. And that's happening around the world. That's one of the few global phenomenons that's not just the US. So the US is building data centers, but so is everybody else.
Exactly. And then just before, we've got some Australian charts here, but some of the adjacencies, this kind of relates to the Australian economy. I've considered an adjacency to be the energy stocks, the energy, the infrastructure, as well as even financials, because financials have to provide finance into some of these companies that are going to continue to need capex.
Yep.
And they can't ultimately run their coffers dry with that. They will need to go to bond markets, go to the equity markets to access capital.
Yeah, exactly.
Do you see that as being a prudent thing, and diversification across the cap size as well, as we try to diversify away from large cap tech?
I guess anyone who's watched Australia for a long time knows about the 2012 gas boom. And at that time, that was 5% of GDP on its own. And the RBA increased interest rates back then because their justification was, well, let's make room for this capex boom. And now we've got, well, there's sort of benefits. So all this gas is flowing thanks to that CapEx boom. So that was a mix of bond markets, equity markets, and finance. So we put the infrastructure in place. Once the infrastructure is in place, you've just got your income stream after that in the form of gas or iron ore or whatever resource of choice. So now we're building data centers. What does the output look like? I'm not entirely sure. So in terms of, I don't know how people are lending for a data center when it's really hard to necessarily price your forward revenue stream. I think it's a bit of a tough one. So I guess that's why we're saying that people are piling into tech, knowing that they're not actually quite sure. But if you want to lose money, you stay away from that sector. If you want to make money, you're in the sector. But as we've seen a few times, as soon as there's a small ripple, remember the Sasamageddon or whatever you want to call it.
Apocalypse,
Yeah, so it fell 26%.
Yeah.
So people are so on edge because we're one headline away from, I don't want to be in this, but I have to because everyone else is and I don't want to underperform. But it feels like people are very quick to cut and run. So that's why we're in for volatility. So if we're here to say we can all sleep at night, I think we're a long way from being able to do that.
Well, speaking of sleeping at night, tomorrow is the budget. And I suppose in terms of the only headline I've seen, I hear there have been some leaks in advance of this.
Always.
But tax breaks, super changes to kick in on the 1st of July. What do you foresee? And maybe this is more for the Australian listeners and an audience as opposed to a global phenomenon, but just in terms of you're wrestling with problems that are globally felt.
Well, it is a global problem. And so there's 2 budgets a year, but this obviously the May one is the big one. So if you're going to make a big decision, this is the budget to use it in, the platform to use it, sorry. But they've always leaked the budget. The actual budget night, I mean, I'm an old economics nerd, so I will watch the Treasurer speak from 12:30 onwards and oh, what a great idea. So there's probably not much left to be revealed. So there's small income tax cuts. This is the 3rd year. And I think what's the most controversial and what the investment community is most focused on is the change to capital gains. Because if you hold something for 10, 20, 30 years, you assume that you will be 50% of your marginal tax bracket, and that's how you plan accordingly. So taking that away in whatever way, shape, or form is sort of taken away that social contract that people have put into place. What I do suspect, and this is the only time I'll mention politics, so superannuation is a Labor government policy. There's a strong possibility that they will make superannuation capital gains tax exempt. It could be out there already, I don't know, but that's to me would seem the strongest possibility, that people are in a compulsory system that they set up. You can't change the underlying tax rules. So what it does mean is after tax returns, instead of crunching all your models and go, okay, after tax returns are going to be 14, 13, 10, instead they might be 10, 9, 8. And you just have to rerun your models with changes of the tax system. Does that impact mum and dad? It does to a small extent because they're talking about negative gearing. Negative gearing is an issue that was brought to the table in the 2019 election and got totally thumped. So this has been brought in again because there's such a super majority with the Labor government. It's the idea of fairness, is how come investment property owners can own 20 properties, whereas the first homeowners can't get a leg in. So this is some degree of optics, because if everybody stops holding investment properties, then you have no rental market. And the rental market will go through the roof, which punishes the first homeowners because they're paying higher rents and therefore they've got less capacity to save up for their. So it's a good idea. And of course, the mechanism of this is they can announce all they want. It has to go through both houses of parliament before it becomes legislation. But I think they're trying to do the right thing, which is the system favours investors and punishes first homeowners. And I think that's the message they're trying to get through.
And it's interesting, I suppose, from our perspective, looking into Australia, we see you as a very engaged population because of the super system. That there's that marrying of Main Street and Wall Street, that individuals feel they're viscerally attached to perhaps their pensions, which is an engagement thing, it's a good thing. Other countries would love to have that level of engagement. And because usually that's equity based, there's a kind of a participation in that making that Wall Street uplift. So that's a good thing. What I would love to ask from the audience here is, seeing in the UK, the last budget was lambasted as a very anti-growth budget. It was there were high taxes. It was not considered. I mean, and near the US, what is considered pro-growth is tax cuts and lack of less regulation and just a very kind of permissive system for growth, because that is essentially growth is perceived as the only way to grow your way out of the fiscal budget problems or some of the others, the other issues around whether it's stagnant, other aspects of the economy. So, and do you see this system and these tax cuts that are being discussed as being pro-growth? And maybe Alistair, given you sit in an international firm that invests in private equity, how do you see it?
I think tax cuts are good for everyone, so that's what people want. The challenge is always going to be how do you stimulate growth in the economy? And so if you penalise businesses, you actually penalise employers and their employees, and you've got to get away from penalising businesses. And that's what we saw in the UK, perhaps in the last budget. In Australia, there's a lot of encouragement for people to get out there and work to cover the cost of living, and so full employment opportunities exist. This is a growth and startup economy from my point of view. I see lots of Series A, Series B, Series C funding. These produce companies that are revenue generating and profitable. Once those companies get to a certain size, then they will look offshore and grow externally. So there's actually, I think, a good set of conditions here for private companies, their employees and employers to do well in this economy.
And then from your vantage point, does this mean that private equity firms globally see Australia and adjacent economies as an interesting potential market?
You both touched on it when you said that you saw the volatility of the tech market and the public markets earlier this year. I think people have to be reminded that 95% of software companies are private. And so the opportunities don't exist in public markets, they exist in the private markets. And so that volatility you wouldn't see if you've got people with hands on the tiller controlling what's happening within the companies and trying to get them to grow. You're right, the overseas international companies are looking at Australia, speak the language, the legal systems are robust. There are opportunities to find companies here that you can take internationally and grow. So huge amount of opportunity.
I think for the last, I try to keep us to time in terms of we cycle through inflation, interest rates, we cycle through equity markets, touched on geopolitics such as it is. In terms of other asset classes, here in super funds, you do dabble in other asset classes to a varying degree. This is an area, I suppose, with infrastructure, real estate, we know that that's been popular, maybe a little less so as equity markets have been on a tear. I'm going to just ask the kind of the challenging question around private equity, and given has a challenged returns recently, as well as private credit. Do you see any problem there in terms of the kind of something hiding in plain sight, perhaps, that we haven't yet uncovered? Or do you think that markets have already voted with their feet in terms of selling the private credit they can sell?
I think the problem with private credit is it got overtaken by clickbait headlines when you get the Jamie Dimon saying, the cockroach. But the great analogy that I read, just because one stock collapses doesn't mean the entire equity market is under question. And as we know, some of those early cockroaches were subprime auto loans, which were people fleeing the country and abandoning their vehicles. So that's not a systemic risk. That was a particular concentration risk. So I think we do conflate a problem with an entire industry. So Hesta as a whole, we're a big holder of infrastructure. Because you're a long-term fund, we know it's not liquid, we know that. But if you hold illiquids, you get your double-digit returns over time. A lot of infrastructure that we hold is CPI plus revenues. And as we've been saying a few times, inflation is everywhere all at once. So anything that's linked to inflation is a good long-term hold, and infrastructure is a perfect case for that. We're actually looking into commodities, because commodities, because we're sustainable, we don't have fossil fuels, but there's ample opportunities in renewable linked commodities. So we're looking at that as an alternative sleeve as well. Now, property's probably more cyclical than you think. And the whole problem with property is that we had a bit of a re-rating in the office market. And so everyone's property portfolios got re-rated from the office market. But as anyone will tell you in that property sector, basically the CCC offices can't be let. Well, good, fine, let them fail. We don't let things fail anymore. That's a whole different conversation. And so having to rewrite your portfolio because you've got substandard office blocks is a decision that your team didn't look into very well. If you hold well-rated property infrastructure, you will be rewarded in the long run. So there's lots of other opportunities. We do get obsessed with equities because that is the day-to-day volatility. I mean, we give our members their daily unit price so they can look every day. But a lot of it doesn't move. A lot of it is just delivering returns over time, but it is tempting to get caught up in that equity market noise.
And it might be on the minds of people here, the housing market, clearly seems to be the topic on everyone's list, always has been for the
I can't believe we lasted this long.
Well, it's probably very unique to the audience here. Is your take on where we are in that cycle?
We all know it's an expensive market. The reason why it's an expensive market is ever since in 2000 here was our introduction of the GST, so the Goods and Services Tax. And so what the government at the time said, everyone's going to be taxed. You know what we could do? We could introduce a first homeowners grant to help people because the cost of building a house was about to jump because it was going to be eligible for GST. And it felt like every time there was a slight ripple in our economic activity, oh, let's do a first homeowners grant, let's do stamp duty discounts. And so we've had this, it's not even cyclical, it just feels like help after help after help after help has been into this market. And this current government's done the same thing with a 5% deposit loan, for example. Now, the problem with the 5% loan is that there's now a cohort that are starting to feel stressed because after 3 rate rises, you have no equity in your house if you're borrowing 95%. So we're starting to see some cracks in that sort of market. But everyone knows the metrics. I mean, you used to be able to borrow at 3 times your income. Now you need 6 times your income. We all know those metrics. But it's the only tax-free asset we have in this country. And so pouring your money into housing is still the #1 asset for people. And as long as it's included, it's excluded as a principal place of residence in order to assess your ability to collect a pension, you are also incentivized to pour all your money into that house. So the policy is the reason why houses are as expensive as they are.
A very unique Australian phenomenon. Well, I think in the interest of time, and I know people have meetings to get to, I'll stop the recording there. But Annette is staying around, and I know that Kate has just joined us. So welcome, Kate. Well, you didn't just join us, but thank you very much to everyone for coming. I think this was a fascinating discussion. Annette, thank you so much for taking us through. We probably could have done a half-day seminar on these topics, but I hope it illuminated some of the areas that are relevant to Australians and the market and tomorrow's budget. Let's see what happens. Thank you, Kate.